So what I'm going to go over now is some of the most common tax deductions and tax credits that are often overlooked by dentists.
Mhm.
Perhaps one of the biggest ones that have come into play has to do with the SALT tax.
Okay.
I'm sure many of you have heard about that, but just to go over that, back when President Trump was in office, some of the sweeping tax law changes he made was dramatically limiting the number of personal itemized deductions you could take on Schedule A of your personal tax return.
Mhm.
Well, one of those reductions had to do with the deduction for state and local income tax. So that relates to sales tax, real estate tax,
Mhm.
as well as state and local income tax. So if a dentist had, let's say, $100,000 worth of those type of deductions,
Mhm.
he would get a tax break for it. Now that number on the personal tax return has been limited to no more than $10,000 per taxpayer.
Mhm.
That presented a big problem to many taxpayers, even more so for higher income earners, because it limited one of their major tax breaks. So that's what the SALT tax is all about. So as far as the SALT tax is concerned, many Democrats, Republicans, a lot of people weren't happy with it, especially in states that were high income tax states,
Mhm.
such as New York, California. So they needed to find a way, these states, to make a difference in terms of this limitation that was imposed on them.
Mhm.
And starting in 2021, a few states came out with a strategy. Basically, it's a tax loophole to that $10,000 limitation.
Okay.
So what that entails is if you have your dental practice set up as a partnership, typically if it's a partnership, it should be a professional limited liability company partnership,
Mhm.
but you need to have two or more owners to be categorized as a partnership. But even if you're a one-man show, you could be a subchapter S corporation
Mhm.
and still be in a position to take advantage of this workaround in the tax law. And what this does for you is does the following. It takes your state and local income tax that would otherwise not be deductible to you personally. And by making a special election, you can now pay those at the entity level. And what that'll do is it'll give you a tax deduction at the entity level.
Okay.
But in addition to that, which is amazing, you're also going to get a tax credit at the state level. Very, very powerful tool. So by implementing these rules, you're going to be able to take something that basically wasn't tax deductible, and now we're going to transform that and give you the benefit of a federal tax deduction and a state level tax credit.
Okay, great.
Now, as of today, there are 36 states that basically allow this workaround,
Okay.
and one city, which happens to be New York City, that allows you to do that as well. These laws or workarounds were first implemented by a number of states back in 2021. A lot more joined in on this in 2022, and a few have actually added this as a tax break in 2023. So depending on what state your viewers are from, they need to consult with their tax advisor about this workaround. And the short version of it is called PTET, and that stands for pass-through entity tax.
Okay.
If you're not taking advantage of this, you're literally throwing away tens of thousands of dollars in unnecessary taxes.
Wow.
So to give you a simple example, let's say you're a successful dentist and the profit on your practice this year, not counting your salary, is let's say $900,000.
Mhm.
On that 900,000, let's use an even number, make the math a little simpler. Let's call it $1 million profit. So if you have $1 million profit in your practice, by implementing this strategy, you'll be able to pay the state and local taxes related to that profit that normally you would pay personally through personal estimated tax payments.
Mhm.
Now you're not going to pay that personally. Your dental practice will pay the tax on that. Now, let's assume the tax on that in your state comes to $100,000.
Mhm.
you're going to pay that 100,000 through your dental practice, again, the partnership or S corp.
Mhm.
That will reduce your federal taxable income by $100,000.
Mm.
That simple step, if you're in the 30% federal tax bracket, will save you on $100,000, $37,000 in taxes. But it gets even better. Not only are you going to get that $37,000 reduction in the amount of tax you're paying
Mhm.
At the federal level, but now you're also going to get a 37,000, not 37, assuming you paid in 100,000 in state and local tax through the entity, you're going to get a $100,000 state tax credit at the state level.
Wow.
Tremendous opportunity here. Tax deduction at the federal level, tax credit at the personal level, as opposed to not getting either one of those at all if you're not taking advantage of this.
Wow.
This is perhaps one of the most powerful changes in the law that I've seen in many, many decades. And again, we got to give credit to the states for implementing this workaround,
Mhm.
because if the states didn't allow it, then you're not getting it. So you definitely want to look into this. If you're not taking advantage of it, definitely get on the phone after this podcast with your CPA enrolled agent
Mhm.
and ask them, are we eligible for this? Are we taking advantage of it? If the answer is no, the next question has to be, well, why are we not taking advantage of it?
Mhm. That's tremendous. Those are big numbers. I mean, you talk about shifting a tax burden to that extent. That's huge. So,
Absolutely. And you know what's even more interesting? Because of this change implemented by the states, the way the law works now with this workaround, these deductions and credits are more valuable than they were before the SALT limitation came in the first place. So dentists will actually be much better off
Isn't that funny?
than they were even before the tax restricted what they could deduct. So I've never seen such a great loophole in the tax law. And for as long as the federal government allows it, you got to take advantage of it, because they could potentially shut this down in a few years.
Mhm. Yeah, boy, that is funny to see how that went from being. I remember when it came out, and people, the states that are higher tax states were talking about just how negative this was and the ramifications therein, and now that it's turned into something that could be beneficial. So it's important that everybody knows about that for sure.
Absolutely, it's a net winner if you're utilizing it, as opposed to just being a complete loser where you can't take any deduction at all.
Right. Right. Yeah. I mean, that's huge. So hopefully everyone is checking now. Could they go back if for some reason they check with their accountant and their accountant says we missed it or they didn't do it? Could they ever go back and try to get it for previous years?
Yeah, unfortunately, with this, the answer is going to be no, because you have to make, and I can't say in every state, because some states may still allow you to go back.
Mhm.
But what the bottom line is, you have to make an election on your state return.
Okay.
Actually, even before you file your state return, you have to make a special election that you're going to do it this way. And then if that's approved, then you can take advantage of it. So unfortunately, for most of the listeners, if they didn't take advantage of it in 2021 or 2022,
Mhm.
and if they haven't made the election yet for 2023, there's a good chance they're not going to be eligible for this until 2024. So again, they have to go back, speak to their tax advisor, and if for some reason they were entitled to it because their state allowed it and they're not taking advantage of it, well, they're going to have to make a change there real quick so they can start doing this going forward.
So there's a deadline that they give you that you have to apply for it, separate from the typical tax deadlines.
Exactly, and it's a state by state rule because it's a state tax break.
Mm-hmm.
So some states will allow you to make the election as late as March 15th of the year you want to get the advantage of that tax credit.
Okay.
So again, they have to go back, see what their specific state rule is, and then if they could qualify, they definitely need to do it.